Big events like Fed decisions can sometimes create volatility for the stock market and your own portfolio. How will your portfolio be affected? It can be hard to predict, but we often see knee jerk reactions to Fed announcements, and that volatility can be unnerving, whether it's the results that we expected or not. Not to mention, Fed decisions can have longer term effects on overall stock market trends. Ripple effects also include sector rotations. New sectors and industry groups can come into power overnight. The best thing you can do is be prepared and know how to react to whatever happens. That's why it's always smart to have your pre-Fed announcement checklist, because we've got to be nimble and ready to act no matter what unfolds. The first thing you want to start with on your pre-Fed announcement checklist is, what kind of market environment are we in heading into this risk event? Is the market in a position of strength, or are we looking weak? A great way of figuring this out is by looking at IBD's recommended market exposure. 0% to 20% will tell you that it's a pretty weak market, while 80% to 100% will tell you that it's a much stronger market. IBD takes into account many criteria to make this decision, including if the major indexes are above or below certain key moving averages. Also taken into consideration is market action in recent weeks, the number of distribution days, if we're in an uptrend or not, and much more. The bottom line, start with the market as it is and ask, what kind of conditions are we in, and what are the key levels on the major indexes that we want to watch? Indexes undercutting key levels and heavy volume in reaction to Fed announcements can be a sign to maybe cut losses. This takes us to checklist item number 2, plan for different scenarios. Ask yourself, what would a bullish reaction look like? Are there recent highs that we want to see taken out? And on the downside, ask yourself the same question, what would a bearish reaction look like? Perhaps we'd see the major indexes undercutting their 50-day moving averages in heavy volume. The point is, you want to envision where we are today and what the market would look like if we had a positive reaction or a negative reaction. Then, based on that, we need to ask ourselves, what portfolio decisions would I need to make to lean more bullish or lean more bearish? IBD's Mike Webster recommends rating the stocks in your portfolio, A through F. As long as your A stocks are acting right, these are names that you want to hold on to the longest. Granted, if they're undercutting moving averages and triggering sell signals, then always take what the market gives you and react accordingly. But ideally, these are your highest quality stocks with top fundamentals and technicals. With B stocks, you may or may not decide to trim back on those positions, but when it comes to C and D stocks, you may consider letting these go first should the market take a turn for the worse, and signal that it's time to lighten up on your overall exposure. Especially during strong uptrends or power trends, investors would be in their right mind to take a punt on stocks that maybe don't have perfect fundamentals or technicals. However, in difficult moments, these will likely need to be the first to go. When the stock market is signaling a pullback, whether triggered by a Fed announcement or not, it's smart to stick mostly with your higher rated stocks. Investors should also make the conscious decision to try and make your adjustments ahead of time before the event. When the Fed decision and following press conference are first released, trading algorithms often parse the text and deliver knee-jerk reactions, which causes a surge of volatility to come into the market in the minutes and hours following the announcement. It's best not to react to that reaction if you can help it. Try to act beforehand. Going into the risk event, have your stocks rated A through F. Be especially aware if you're going into that risk event with C, D, E, or F quality stocks. Know that your portfolio is taking on some extra risk. Next on the list, it's important to be aware of how things unfold between various industry groups. IBD investors talk a lot about sector rotations and the way that money can rotate from one sector to another. Tech stocks could be leading the market one day, then big money starts to pull out of tech and rotates into industrial stocks or defensive stocks. It's important to have an awareness of what groups could be affected by interest rate adjustments. Whether the Fed is raising, keeping the rates the same, or lowering, you should have an awareness of how that might affect the stocks in your portfolio, if at all. Some groups are certainly more sensitive than others. Here's IBD News editor Ed Carson to help explain.
When you're looking at interest rate sensitive stocks, and and that includes the more speculative growth names, but definitely home builders and some financials to some extent, those may have different reactions. Those are things to keep in mind. If you have stocks that are likely to move a lot, and you'll know if you have home builders and money losing speculative growth stocks, like TEM, and that's your entire portfolio, you could see some really big swings uh, on the Fed day. I mean, but if you have more stable companies, a bunch of long-term leaders or other things, there's that. I might be completely right on what the Fed says, and the market may have a completely different reaction to what is there. But yeah, I think that's there's definitely some areas, and you just have to also remember that at 11 o'clock Pacific time, there'll be that news, but then Powell comes and that's usually the big thing. And so it literally can be that hour into it before you get any idea how the day is going to go. And as Arnie said, the next day matters. But yeah, heading into it, I usually don't do a whole lot. There have been some times where I've been like, I feel like it's a monumental meeting and it just feels like so many things, or the market's really weak or the market's really extended, and I might trim a little bit, but that's probably just adding to my other concerns about things or my other concerns or hopes rather than a major driver. But make no mistake, if the market makes big moves, you're going to want to you'll want to take some action.
And the key thing to remember is it's not about taking big swings and going all in or all out. IBD methodology stresses being incremental. It's important to take the market signals as they come and adjust little by little based on what's happening and what criteria are being triggered. You may have seen with past Fed announcements, there is often a counter reaction that comes soon after the initial reaction to the news. Perhaps that first reaction is not going to be the ultimate reaction that plays out. We often see a reversal of that initial trend. A great resource for investors to visit is federalreserve.gov in order to read in detail about the Fed's decision at its FOMC meeting. The FOMC statement after every meeting is pretty brief and relatively easy to digest. And in some meetings, the participating board members will offer their forecasts for the economy and interest rates, and that's found in a survey document known as the SEP, or the Summary of Economic Projections. The biggest key here is to remain open-minded. There's this tendency to want to place bets on what's going to happen or what you think is happening so you can profit off of that, but it's much less risky to react incrementally little by little. And you'll be able to do this well if you're already prepared ahead of time for those different actions that you would take based on what the market does.